So off the top, Michael, what's the one job of an equity investor?
Well, I think, Cameron, if the question is an equity investor trying to generate excess returns, the answer is to try to find some sort of edge, right? Some sort of variant perception. And the way I might distill that is to distinguish between fundamentals and expectations. I'll just mention that this is a lesson I learned from my mentor, Al Rappaport, who wrote about this in his book, Creating Shareholder Value in the mid 1980s.
Mm.
And Al's been a longtime mentor and collaborator and just a wonderful friend. Chapter 7 of that book was called Stock Market Signals to Managers. It was meant for executives, but it's exactly the same mindset that we can use as investors. And the idea is simply that a stock price, or any asset price, but a stock price reflects a set of expectations about future financial performance of a company. And your job is to figure out whether those expectations are too optimistic, too pessimistic, or about right, which is usually probably the right answer. So it's very much like a handicapper, right? It doesn't matter which horse is going to win the race. What matters is which horse or horses are mispriced relative to their prospects.
Exactly.
And then when you get down to fundamentals, it's really, how much money can the company invest at what return on investment? That combination of investment and returns gives you a sense of cash flows in the future. And of course, the notion of sustainability means that you can find profitable above cost of capital investments over time. So how long can you pull off that trick? And those are some of the ingredients that go into it. But that if you had to say what is the one job, to me, that would be what I would answer.
And can you link that on a fundamental basis? Like, at the very simplest, most basic level, where do stock returns come from?
Like any financial assets, the present value of free cash flows, right? Which is the ability to disperse cash back to the owners of the business. Cameron, I always like to say that I grew up in a small town in central New York, Ithaca, New York, which is home of Cornell University. My father was a car dealer. And, I would say relatively unsophisticated in terms of financial stuff, but it was very clear where our family's wealth came from. It was the cash flows from his business, right? And so, if inventory levels got too high, it was worrisome to him, right? So,
Hmm.
he tried to obviously pay all the taxes he needed, but if there are strategies that he could minimize his taxes, so it was really the cash flows. And so that was always in my head. It's the present value of the cash flows, i.e. the cash flows that can be dispersed back to the owners of the business over time. So yeah, that would be, I think, the fundamental answer to that question.
Okay, so let's link the cash from the business to the other question that comes up all the time. How important, or perhaps unimportant, are dividends to total shareholder return?
This is such a fascinating question. By the way, I think, I talked about dispersing capital. There are three ways to do that, right? Dividends, share buybacks, and M&A. So selling your company for cash.
Yep.
I find that people like dividends too much and don't like buybacks enough. There seems to be a lot of confusion about both those topics. But so the answer is if you're thinking about total shareholder returns, or essentially the capital accumulation rate, which I think that you and I care about when we're thinking about wealth creation or wealth building, the I think counterintuitive answer is dividends are actually not important. And we just need to think about how that could be the case. And the answer is for you to earn the total shareholder return, the requirement is you need to reinvest 100% of your dividends without friction back into the stock.
Right.
Right. So if the stock's at $100 and they pay a $3 dividend, what happens is the stock goes ex dividend, of course. So the price adjusts back to 97. And then that day you have a $97 stock and $3 of cash. What a TSR requires is that you take your $3 and buy more stock with that. So you get your capital, and quote, your capital balance back to 100.
Right.
So this is, and by the way, most people don't do that. Most people spend their dividends, which is perfectly fine. And it leads to this idea called the free dividend fallacy, right? Which is, Hartzmark and Solomon have written a bunch of stuff on this. They wrote a paper called The Dividend Disconnect.
Yep.
I think it's a Journal of Finance that very much spoke to this. So the answer is, unless you're reinvesting 100% of your dividends without any friction, you're not going to earn the total shareholder return, and dividends in and of themselves don't matter. Now, let's by the way, there's one other comment I'll make, which is interesting, is if you do that, you reinvest your dividends with no friction, or the company buys back stock, the same amount of stock instead of paying a dividend, and you do nothing. Both of those are doing the same thing from a practical point of view, which is increasing your percentage ownership in the company.
Yep.
Right. In the dividend case, you're buying more shares and the share count doesn't change. In the buyback case, you are not selling with a smaller share count.
That's
So
right.
in both cases, you're actually increasing your percentage ownership in the company. So, um, yeah, I think that's the answer. Now, the one say you say why would dividends matter? They might matter for things like signaling effects. They might matter for capital discipline. So the company, giving the money back to their shareholders rather than doing something dumb with it. So there may be ancillary benefits of returning capital to shareholders. I mean, by the way, buybacks might do that just as effectively as dividends. But in terms of people say something like 60% of the returns of the market come from dividends. That just is not mathematically correct if what you care about is the capital accumulation rate, which is, I think, what your clients and most
Yeah.
of us, when we're thinking about retirement or paying for our kids' college saving, education, or whatever it is, that's what we're going to care about.
Yeah, we've all seen those charts that show the percentage over time that the return is dividends. But it's not like if you didn't get the dividends, the money would have just been incinerated. It would have been retained by the company and used for other purposes. It doesn't just go away.
Exactly.
Can you comment on the behavior of investors in dividend stocks?
Well, I think that it's I think the evidence on this shows, and by the way, this is true for institutions as well as individuals, is that a very small percentage of investors actually reinvest their dividends. So I don't know if that's what you mean, but they do not reinvest it. So the total shareholder return number, which is the most widely cited number for companies typically, virtually nobody earns the TSR, right? If you could only do it if you had an automatic dividend reinvestment
Right.
program and a tax-free account. And some people do have that, but it's a small percentage of the total. So, yeah, and so that's why these guys call it. Again, people tend to consume, and this is a classic mental accounting. You think of the value of the stock as sort of your capital account, and then you get sort of free money, right? So
Right.
that's precisely what these guys I think meant by this idea of the free dividends fallacy.
Yeah, and the passion is for dividend-paying stocks for many people is so high. I think a lot of those people have a preference for dividends, therefore they might behave better, if there's market volatility in dividend stocks.
Yeah, that could certainly be true. And the other thing is that it's you could argue that a company buying back stock, you could create a homemade dividend, right, by selling your prorated amount. Now that's very easy to say and rolls off the tongue, right, from an academic point of view. From a practical point of view, how many people are really willing and able to do that? Probably not many. But again, in theory, these are things. There are ways to extract capital from your investments, obviously.
Okay, so what are the problems with classifying stocks or even managers, I guess, as value or growth based on measures like price to book or price to earnings?
Yeah, I think Charlie Munger talked about this. I certainly believe this myself. Value investing is absolutely essential, and value investing only means buying something for less than what it's worth. Full stop, right? So I think Munger said all intelligent investing is value investing, and to that degree, I think that's true. By the way, I teach at the Howard Center for Graham and Dodd Investing at Columbia Business School. So this is sort of the carry of the Ben Graham tradition, which is sort of the whole value investing tradition. I think what's happened is the notion of value investing has gotten conflated with the value factor, which is, saying that you should essentially buy statistically cheap stocks, as you mentioned, multiples of earnings or cash flows or price to book, and sell the ones that are statistically expensive. Now, the key is that those multiples may be proxies, right, for low or high expectations.
Right.
And so low multiples just mean low expectations. We talked about at the top, fundamentals and expectations that, broadly speaking, those companies are going to be companies with low expectations. And broadly speaking, high multiples are going to be high expectations. But we really do need to take another level to understand it more effectively. So saying it all differently, all things being equal, lower multiple is better than a higher multiple, I guess, to state the obvious. But it's really the key is how the company's going to perform vis-a-vis those expectations. So as I would like to say, expectations investing is like, the bar is where the hurdler, the bar is a level for the hurdler to clear, and the company's fundamentals are how that hurdler can jump. the bar could be set at a foot, but if the company can only jump a half foot, you've got a problem. And the bar could be set at 6 feet, but if the company can jump 70 feet, 7 feet, it's going to be a fabulous investment. So it's not, but obviously high bars are harder to clear than low bars. So it's really, we just need to take the next step. So I think we just need to distinguish between value investing, which is going to be a sort of an immutable good idea, right? Buying something for less than it's worth, versus the value factor, which, I think we'll talk about it, might have some other limitations as well, in terms of giving us the signal of low expectations.
How has the increasing importance of, intangible assets affected the way firms you think should be valued?
Yeah, and Cameron, I think this is a perfect follow-up for the value factor conversation. Just to level set with all the listeners, rough numbers, but in 1975, these are data from the United States, although around the world you get similar patterns, maybe not exact ratios, but same patterns. 1975, tangible investments for U.S. public companies were about double those of intangibles, right? And let's just define our terms. Tangibles are exactly what you think of, factories and machines and, things you can cut, touch, feel, and kick. Intangibles, by contrast, are things that are by definition non-tangible. So this would be things like software code or branding or marketing or training your employees and so forth. Okay, so 2x tangible to intangible in 1975. Our estimate is for 2025. So let's call it 50 years later, that ratio will be flipped. It'll be twice as much intangible to tangible. Okay, so interesting, but why do we care, right? And by the way, in some fundamental way, we don't care, right? An investment is an outlay today in the anticipation of greater cash flows in the future that compensate you for it, right? So that idea is the same whether you're investing in tangible.
Yep.
What's important is the accounting is different, right? And there was actually in the United States a very interesting case by the FASB in the 1970s where they decided to expense research and development versus capitalize it. Now, if you go back and look at the history of this, it was actually not like a layup decision, right? They actually had a lot of discussions about different ways to handle R&D, and they just came to the conclusion that the payoffs were sufficiently uncertain that the most conservative, in quotation marks, conservative approach would be to expense it. Okay, so what's happening is these intangible investments are getting expensed on the income statement and selling general administrative, SG&A, whereas tangible investments are being capitalized on the balance sheet and then depreciated over time. So Cameron, let's just try to make this a little bit vivid with one simple example. Let's say you buy a machine that costs $1,000 that lasts 5 years and it's NPV positive. Let's just say it's got good cash flows. It's a good investment. So how do we account for that? We put the machine up, it goes into a net property, plant, and equipment at $1,000. We then depreciate it over 5 years, $200 a year, and then it's done, right? Fabulous. Now, let's say you're a customer business, a subscription business, and it costs you $1,000 to acquire a customer. Let's say that customer is going to churn in 5 years, so we know they're going to go away. They're going to generate the same stream of cash flows as the machine, right? NPV positive. Well, how would that accounting work? Well, the answer is we're going to expense that full $1,000, and then we're going to get those benefits from that customer over the next 5 years. Well, if that's an NPV positive thing, the more of it we do, the more we're actually going to lose money, right? Because we're taking the hit up front versus an accrual over some period of time. So this is the interesting observation. And then now the devil's in the details, which is how precisely do we go through the SG&A item of every company and say what is maintenance, and there's SG&A we need to keep the business as it is in terms of market share or revenues or whatever, and then what is discretionary intangible investment, right? So this sort of maintenance versus discretionary piece is really the big thing. And by the way, there are multiple threads of academic research on this, which are fascinating. I think most quants now use Peters and Taylor, which is a sort of default assumption. They assume 100% of R&D is intangible and 70% of non-R&D SG&A is, 30% is intangible. But you can refine that, and there are actually some very interesting research papers refining it. Okay, so what happens if you do that? Let's just state the obvious. Earnings go up, right? Because we're removing an expense. We are adding an amortization, but we're removing an expense. And invested capital goes up. Now note that free cash flow, the number we care about, the lifeblood number we talked about before, doesn't change, right? Because you're increasing earnings, but you're increasing investment by the same amount. So free cash flow doesn't change. But it gives us a more refined view of the profitability and the invested capital. So the question is, should I care about that? And the very first question you ask is, what is the one job of an investor? And if we're trying to understand fundamentals, I think this idea of understanding the magnitude and return on investment becomes extremely central. Okay, so just to give you some guideline on this, these are our estimates, ballpark. But if you capitalize and amortize intangibles for the S&P 500, for instance, we estimate that earnings would be somewhere around 10 to 15% higher than they are. Again, there's an offset. The invested capital will be higher, but 10 to 15%. So if you are relying solely on multiples, you would be overstating the multiples. So the multiples may not be quite as onerous. And again, the application of this concept varies widely. Some industries are still primarily tangible, so this is basically not an issue. Whereas other industries are almost solely intangible, where this is a huge issue. So that is, to me, I think the important point here on thinking about intangibles and how they've risen.
Wow, that is so fascinating. And how permanent do you think the advantage gained by companies that successfully invested in tangible assets?
That's a $64,000 question. I think it's to be determined, kind of an open question to some degree. Let me just, if you ticked off basically sort of how they're different from tangible assets, and there's a wonderful book called Capitalism Without Capital, which I would recommend to all the listeners by Haskell and Westlake. And they talk about it's kind of, they're marketing guys. So they talk about the 4 S's. Scalability. So scalability means that it's often for an intangible asset expensive to create the first version, but relatively cheap to do incremental versions. So you think about writing software code or developing a drug. And so if your product or service is successful, the incremental costs are low, so you can scale really fast, right? So you're going to see that with intangible companies. The second is sunkenness, which is the opposite, which is if your intangible thing is not valuable or successful, or so it becomes obsolete. So it becomes a sunk cost, right? Whereas if you, for example, Cameron, started a restaurant and didn't work out, you could sell your inventory and your cash register and your chairs and tables and so forth. So there would be value to somebody else. The third one is spillovers. Spillovers just says it's really hard to protect the intellectual property, right? And we know that through, best practices tend to diffuse. And then the last idea is that a lot of innovation, interestingly, is the recombination of building blocks of ideas. And to the degree to which those building blocks are digital, they can be, we can find solutions faster than we could before. And I think that's a really interesting question today. So the question you pose, a more important one, is how permanent are these things? I do think it's an open question. I would recommend a book that might shed some light on this by Jim Besson. He's a professor at Boston University. And the book's called The New Goliaths. And Besson, it's got a lot of interesting factoids in there, but he makes sort of 3 fundamental points. One is increasingly the very large companies, so think about the Magnificent Seven type of companies, are spending large amounts on proprietary software. Okay, so this is intangibles, but this is proprietary. And the estimate is something like that dollar amount is about 1/3 of total R&D being spent. So it's a big number. The second point he makes is that proprietary software is allowing these companies to enjoy sort of classic economies of scale, just like Adam Smith, but at the same time also differentiate their products or services, right? So this would be customization. In a sense, they're getting 2 sorts of competitive advantage, right? Scale advantages and differentiation advantages. And then the third point he makes is this has always been true to some degrees. Companies develop technologies, right, through proprietary efforts and so forth. But what's different is in the past, it used to diffuse. And he's got this really interesting case study of General Motors developing the automatic transmission for cars. And they did that around 1940. And, they patented and all that stuff. But within about a decade, and by the way, there was a world war in the middle, right? Within about a decade, basically every original equipment manufacturer had some version of the automatic transmission. So that diffused. Whereas whatever the secret sauce is at Google or whatever the secret sauce is at Amazon, that's not diffusing, right? Those guys are doing that internally. So that may argue that there's a little bit more permanence than some people think. Here's the last thing I'll mention. This is like high level trivia. Ben Graham, of course, wrote Security Analysis. There are now 7 editions. Perhaps the most heralded edition is the second edition, 1940. And in the 1940 edition, Ben Graham has a passage about intangibles, believe it or not. And in that passage, he basically says these assets may be just as good and just as durable as tangible assets. So that's a kind of a fun little factoid that Ben Graham, now this is nearly a century ago, uh, had an observation that these assets could have some sustainable value. So anyway, I think the answer is an open question still, and I don't want to. And I think there's empirical evidence that it doesn't always go well, but for some companies, it certainly can be a sustainable advantage.
How can investors determine where a company is in its competitive advantage life cycle?
You're asking me all these such fun questions. I love this one too. Let me start by noting that traditional life cycle analysis typically relates to age, right? And it's a basic story that we could all tell. You're a young company, you invest a lot, right? You're not making profits yet. And then over time, you mature, you get economies of scale, your profitability goes up a lot. So you're sort of you're in your prime of your economic life. And then over time, because of competition and senescence and bureaucracy, the returns grind back down to the cost of capital, right? So you get this sort of pattern of up and then fading back down. So and I for years believed this. I taught it. People talk about this all the time. And so then I said to I worked with Dan Callahan, my colleague, and I said, Dan, let's just test this. I'm sure it'll be great. Let's just see what happens to ROIC patterns. When IPOs happen, we should expect them to be bad and we expect them to go up. We saw a picture that looked nothing like what that story was at the top, right? It turns out the ROICs were really high for IPOs. And then they actually went down and they sort of stabilized over some period of time. It was completely baffling to me. Then I called my friends at, Brian Matthews at Holt Value Associates, and I said, Brian, if you run this number, he runs a version of it, and basically the same picture. So I'm like, okay, we got to go back to square one. Well, it turns out we're really lucky because there was a fascinating paper written in 2011 by Vicki Dickinson at the University of Mississippi. She's a professor of accounting, and she did something extremely clever. She combined two really important sets of insights. The first insight was going back to the life cycle work of Steve Kleppert and Michael Gort. So Kleppert and Gort, these are the sort of famous guys on this, and they describe five different life cycles, five stages, pardon me, the life cycle: introduction, growth, maturity, shakeout, and decline, right? So pretty much what you would expect. But then Dickinson did something super cool. She said, how do we figure out which stage the company's in? And she said, well, let's go to the statement of cash flows. Now, I should just mention, by the way, statement of cash flows, at least in the United States, is a relatively newcomer to financial statements. It really wasn't mandated till the late 1980s. And if you read a finance or even accounting textbooks, it's kind of third fiddle, right? People talk about income statements and balance sheets, and most of financial statement analysis focus on those two things. Anyway, so statement of cash flow. And she said, look, there are three parts to it, right? There's operating cash flows, there's investing cash flows, and there's financing cash flows, and all of them can be either inflows or outflows, right? So we have 2 to the third possibilities, 8 possibilities. And then she intelligently placed, based on those pluses and minuses, where a company would be in which stage it would be in its life cycle. Now, I'll say that the Dickinson stuff in and of itself was fabulous. We actually came along and made 3 additional adjustments to it. One is we took stock-based compensation out of operating. So the stock right now, SBC is an add back to operating cash flow. We think it should be a financing thing, so we put it into financing. So it's a capital raise. The second thing is the intangible adjustment we just talked about. We essentially increase earnings and we increase investments. And then the third thing, we remove purchase and sales of marketable securities from investing. And by the way, that was back in the day when this was established, wasn't a big deal. But now some of these companies have huge cash balances, and so that can be distorted. So we put those two things. We did that. We applied the Dickinson thing, and Cameron, it's a sight to behold. It was beautiful. We recovered that pattern perfectly. The ROICs followed perfectly. It turns out the ages roughly follow it, interestingly. And by the way, just to give you a level set, about 75%, 80%-ish are in the growth and maturity phases. So that's still the most popular phase, or those 2 stages are the most popular stages. But the important thing for us is it allowed us now, or allows companies to move from one stage to another. So you're not always just getting older, like the rest of us, we wish we could go back to our youth. But if you're an older company and you find a fountain of youth in terms of a new line of business or some investment opportunity, you can actually go back and
Wow.
go from, for example, maturity to growth, right? And vice versa. So it's a really cool, powerful framework. And then we obviously can do transition matrices, and then we can figure out returns, shareholder returns based on where companies are in various stages. All super, super cool stuff.
So which stage has the highest returns for investors?
Well, it turns out that it looks like maturity has the highest return, but I would just qualify that to say that it's almost always the case that transitioning into maturity is going to be is like or growth and maturity are going to be the best. So we'll I don't know if we can post it or share it, but we wrote a report called Trading Stages, and we have that, and so people should go back and look at that transition matrix, and they can see all that stuff for themselves. But that's basically yeah you can it's maturity and growth is really the sweet spot. Introduction tends to be challenging, right? Because again, you're just investing a lot with sort of uncertain prospects. Decline tends to be not so good because to state the obvious, you're declining. So yeah, those are the transition matrix. I think is sort of the magic, and again, going back to growth and maturity seem to be the most profitable areas.
So does this suggest anything about investing in newer or more exciting type industries or companies?
Well, it's challenge. It's just to state the obvious, it's challenging. And one of the things that I would recommend people do is as well as they possibly can is to understand the basic unit of analysis, right? Which is understand, does this company make money? Going back to our machine and customer acquisition, that's a good example of it, right? The machine, by the way, CapEx tends to be a value creating investment. So when companies do that, that tends to be a good thing. Customer acquisition tends to be less clear, but you can see, for instance, if a company has good customer economics and they accelerate their growth, that should be a good thing, right? Because the fundamental unit economics are good. So that to me would be the main thing is does the basic economic activity make sense? And if it does, and you obviously sometimes have to project and have a little bit of growth in the maturity of the business and so forth. But that to me would be the way to think about that.
How does intangible intensiveness change the base rates for differences of expected stock returns?
Another great question.
Well, it's a classic Ben question.
Yeah, that's a great. This is like a little. You get a lot of nerd stars for asking that question as well.
Well, we'll give them all to Ben. That's not a star to me.
Yeah. So let's back up and say what are we talking about with base rates? And so the idea here is that when analysts or investors model the performance of companies, the sort of classic way they do that is they gather a bunch of information, they talk to management, they listen to earnings guidance, they listen to the analysts and so forth, and then they build a model, right? So they have some sort of sense of what the growth is going to be. Another way to think about growth rates or corporate performance would be this idea of base rates. What a base rate is essentially is appealing to a reference class rather than saying, what do I think is going to happen? What you do is you say, what happened when other companies were in this situation before, right? So I'm modeling a company with $2 billion of revenue, and I want to think about the 5-year sales growth rates. Rather than me forecasting it based on all this stuff I've gathered, I say, let's look at the distribution of growth rates for all $2 billion companies over 5 years, right? And that's a much more, it's actually, many people don't know those numbers off the top of their head, but it's an accessible number, obviously. Okay, so you have this base rate, and that can help temper, by the way, it introduces some sobriety in some cases. We often we tend to find egregious examples, but you can see analysts projecting these really rapid growth rates. And then when you look at the base case, the reference classes, that basically it's a 1% of all companies are doing it. So you're making a bet that seems to be quite extreme. Okay, so let's tie this back to intangibles. We talked about the characteristics of intangibles. One we talked about was sunkenness. And that's this idea that things can become very obsolete, right? So where if you write some software and it's really hot, it can sell a lot, and that's huge economies of scale and do really well. If it's a flop, it basically is worth nothing, right? It becomes obsolete very quickly. So the key thing is with base rates is they're not static distributions that are handed down on high on stone tablets, right? These are living, breathing distributions that change over time. So they're there to guide us. They're not the ultimate answers to anything. So what we found was when we examined intangible intensive industries, what we found was they have similar means and median, by the way, growth rates, but they had both faster growers, so more on the right tail, and then much slower growth rates. So whereas the population may have looked like this, a skinny bell-shaped distribution, the with intangibles, the bell-shaped distribution gets fatter, right, wider. So that means more chance of doing really well, and at the same time more chance of being obsolete. And we could probably think of lots of examples. Usually people pick on like BlackBerry or Nokia as companies that went from being sort of on top of the world to being obsolete quite quickly. And then there's a long list of companies in recent years, the Magnificent Seven would be a good example, that have been able to scale at sort of extraordinary rates. By the way, you think about the growth rates that are being achieved by companies like Microsoft, like Amazon, like Google. There's very little precedent for anything like this in the past. It's just not, companies have just not been able to do that. And the intangible, I think the intangible component of it's an important ingredient in that story.
What mistakes can using valuation multiples alone to value firms lead to?
A bunch of them. And I always say to my students that multiples are not valuation. Multiples are a shorthand for the valuation process, and one should never confuse those two things. So what's good about shorthands? They save us time. What's bad about shorthands? They can have blind spots. So what are those blind spots? Well, number one, Cameron, just to acknowledge this, a multiple is an numerator is basically a number, a value that represents the present value of cash flows from here to eternity. And the denominator is a snapshot, right, of what's going to be earnings or book value this year, next year, or maybe the last 12 months or whatever it is. So you're comparing eternity to a snapshot that in and of itself you could see could be problematic. Second is it doesn't really capture the magnitude of investment and the return on invested capital. So you can have two companies with very similar growth rates, but they deserve very, very different multiples as a consequence of their capital intensity and returns. The intangible investment we've already talked about, so two businesses are very similar. One's intangible intensive, one's not. The non one will have much lower multiple than the one that's got intangibles, even though their economics may be very similar. And then the last thing is interesting is you can get very mixed signals. One of my favorite charts we wrote a piece called Valuation Multiples. One of my favorite charts was actually a plot where the x-axis is price earnings multiple and the y-axis is EV to EBITDA multiple. So the most popular two multiples. And of course, there's a really high correlation, not surprisingly, but you find instances where two companies have very similar PEs and very different EV to EBITDAs, or very similar EV to EBITDAs and very different PEs. And so you get different signals. And so the question is, why are those signals so different? What we featured in our report was Apple at the time we did the report, which Apple and Walmart had the same PE multiple effectively, but they had quite different EV to EBITDA multiples. So unpacking why the PE was the same while the EV to EBITDA multiple was very different was a very fun exercise. And again, sort of illuminating, like looking underneath the hood to understand why these things were different.
Wow. And what are the implications for systematic value investors?
I think that most systematic investors are on this. There's a fair bit of academic research already showing how introducing intangibles, even simplistic ways of introducing intangibles into earnings and book value, improve the quality of the value signal. So I think they're on it to some degree already. So I think it refines it. I have to say that we have these sort of yawning gaps between the value and growth, and I know Cliff Asness at AQR has talked a fair bit about this. I still have a lingering suspicion that part of that is a measurement issue versus I'm sure it's a combination of things, but it's not just a stretch valuation. It may be also a measurement issue in there as well.
Here's another Ben question for you, Michael. How does your thinking on intangibles and valuation extend to the relevance of market-wide metrics like CAPE for saying that the market is overvalued?
Yeah, I think we sort of covered this a little bit. I mean, the intangible thing's not an insignificant piece of that. I watch with some interest, CAPE was developed by Bob Schiller.
Yep.
And one of Bob Schiller's good friends is Jeremy Siegel at Wharton. And Siegel wrote a piece about why about the limitations of CAPE, and part of it's you can modify, and I think you get a little bit better signal. But for example, like it's reported earnings. So if you have write downs, it's not there's asymmetry, right? You can have write downs which will impede earnings, which make multiples look higher, but you don't have write ups. So there are some issues like that. It's also, as you know, it's been a very bad timing. I don't think it was ever meant to be a timing signal, but it's been a very bad timing signals for probably now. I don't know. You know better than me. 20 years probably. So broadly speaking, it's not that I'm being complacent about the market. I mean, I always worry. There are a lot of things to worry about. I'm just not sure that this is a crystal clear bell ringing for all those reasons.